Well, hello and happy January 31st. End of the month, I've got the marvelous Frances Newton Stacy, who recently joined our team as a economic strategist and wealth manager. And just with all of the changes that we've had, we just thought it might be a good time to do a little update, kind of hitting on the new administration and what the Federal Reserve came out with this week. And just for a very little bit of background about Frances, she has been on TV for about 16, 17 years doing economic updates and is a UN ambassador, high level. So, anyway, hey, Frances, how are you doing today?
Hey, yes, good morning. Doing well.
Fantastic. Well, why don't we just dig right into it? So, with yesterday's Federal Reserve meeting, what were you expecting in terms of interest rates or policy changes?
Yeah, so on Wednesday, basically, there was pretty much a sentiment that the Fed was not going to lower rates. They weren't going to really touch rates. But what got everyone's attention was the fact that they had kind of changed in their statement that they were making significant progress toward their 2% target of inflation, which means that they had kind of what we would say more hawkish comments, meaning that they're less excited about interest rate drops. And so, of course, the market's going to try to reprice that in because when they started lowering rates, markets had priced in a lot more of interest rate drops for this year.
Perfect. And, as far as the Fed's current stance on the inflation and interest rates, how do you think this will influence investment strategies with different companies across the board?
I think the one thing that the markets are not expecting is for the Fed to actually start raising rates again. So they started to become a little bit of aware that there is some inflationary risk underlying. A lot of commodity prices have gone up, and the spending is very high. Unemployment remains manageable. There's nothing in the labor market that is screaming that you have to cut rates, and so they're just kind of. I think the sentiment was we're going to do nothing for a while.
Okay.
And of course, he was really pressed in the conference that he does after the decision about the Trump administration. What are they doing to anticipate any kind of changes in policy? And he's a very disciplined communicator, just refused to comment on any of that. But
Yeah.
of course, investors are looking at fiscal spending because that's going to affect the money supply against the goods and services, which affects inflation going forward. And so I honestly think that the Fed cannot front run the policy that's coming out of the White House. And so basically, they just kind of have that wait and see approach.
I gotcha. That's wonderful. What and as far as with the new presidential administration, there's been obviously a lot of changes. What do you anticipate with the new administration's economic policies and how that will affect financial markets in the short and long term?
I will tell you my hope that I understand the desire to cut fiscal spending and I understand the desire to cut regulations as being a pro growth tool. And it does work. The thing is, though, that usually when the Fed raises rates, and they raised rates a lot in a very short period of time, after COVID to get, because we had so much money kind of sloshing around the system because of all the fiscal spending and all the monetary stimulus during COVID, usually that would kind of tip a recession. And even though market participants expected a recession, we didn't have a recession. There were three things that occurred that kept us from having a recession. The fiscal spending, the government spending remained super high into the end of the Biden administration. Number two, when people would normally be defaulting on loans because there's a record amount of debt in the system, usually if banks aren't lending, those people would have to default. That is very deflationary.
Yeah.
Didn't occur because there was so much money in the system. Private credit came in and refinanced those loans. So you just didn't have a lot of defaults. Then people who would normally buy groceries and necessities with savings or salary, which is already money in the system, started buying that on credit cards. Credit cards is new debt, new liquidity being added to the system. So while the Fed was removing money from the system, the
Hmm.
government and the credit cards were keeping the money supply very high. And when loans are defaulted on, that removes money from the system. So that wasn't occurring. So if you think of it as like a swimming pool, everything was filling the swimming pool, and the things that drained the swimming pool really were not having a meaningful impact.
I gotcha. Well, and my last little question is going to be with the new administration stance on taxes, particularly corporate taxes, how do you think that's going to impact the market, the broader market, and individual investors?
So the thing about lowering corporate taxes is that corporations can take some of the expense that would normally be baked into taxes and use it for what we call CapEx spending. CapEx spending and business expenditure is part of the calculation of the gross domestic product, or GDP. So lowering tax policies can be very pro-growth. Now, again, some people fear that it can also add to inflation because more spending, more money
Yeah.
sloshing around the system can sometimes add to, an inflationary environment. Overall, the inflationary or deflationary impacts are really the money supply. So what I would say is I'm very hopeful that what this administration is trying to do is they're trying to switch our economy from a government spending growth model to a corporate growth model or a private sector growth model. The only thing is you've got to be kind of careful, because if you drain that swimming pool too quickly or you make too drastic of an adjustment, it can kind of off kilter or miscalibrate the system, which can trigger credit situations or defaults. So it's all about how they do it incrementally. I do see some conversation on X. Elon, he's saying, if we pull $1 trillion out of the system, we should have enough offsetting growth to, kind of buffer the system from removing that fiscal spending. So he's definitely thinking that way, and that I appreciate.
Fantastic. Any last words that you want to highlight on, or you feel like you've covered it all?
Well, I do think that, earlier in the week we had quite a remarkable sell-off in Nvidia because we had news out of China that DeepSeek was making things, more efficiently, more cheaply, which then, questions the valuations, which are very stretched in Nvidia, particularly, but tech. And Nvidia and the Magnificent Seven tech stocks have been holding up the general indices.
Yeah.
They've been outperforming dramatically the other 493 stocks in the S&P 500. But it's interesting, the markets have kind of recovered on that news because there is some speculation and there's an ongoing investigation that DeepSeek is actually using NVIDIA's chips.
Interesting.
But they're being shipped all over the place. So we'll see how that reconciles. But the big question on Monday was, is this the beginning of a recession? Is this the beginning of a bear market? Or is this just a price readjustment, pending this sort of pronounced competition in DeepSeek? So far, it looks like it was just a repricing of that news, which
Gotcha.
remains to be seen. So that we're always watching, but what we're really looking to see is anything that might trigger a recession. But as of yet, there's a lot of risk in the system with the changing administration, but we haven't seen that sort of trigger point.
Okay. Well, this was perfect. Thank you for some insight, Frances. And I know we're going to continue to do updates. And, if you guys have questions, you can always reach out to Frances or myself. We'll have some information listed. Thank you and have a great day.